welcome to the Nifty Noon podcast.
Thanks for having me back.
So what if I told you that a traditional Wall Street behemoth, one with like $9 trillion in assets, is suddenly acting more crypto native than actual crypto retail traders?
I mean, you'd sound crazy.
Right. But if you look at a split screen of the digital asset space right now, it really feels like we are watching two completely different realities play out at the exact same time.
Yeah, it's a very striking bifurcation.
Exactly. On one side, you have traditional finance aggressively securing foundational infrastructure and, locking down native yields. But then you look at the other side, and crypto-native retail traders are out there experimenting with these explosive, highly gamified liquidity models.
It really is pulling the market in two opposite directions, but both sides are operating with immense capital.
Yeah.
So to give you a comprehensive briefing on the dominant themes from this week's sources, let's just quickly look at the winners and losers of this dynamic.
Let's do it.
The clear winners right now are the infrastructure giants. We're talking companies like Circle and Kraken, and also yield-seeking institutions that are finally getting the financial products they've been begging for.
And on the losers.
It was a pretty brutal week for Bitmart, which is actually winding down operations. And then Leopold faced an absolutely devastating margin call. Oh, and Coinbase took a pretty heavy hit post-earnings.
Ouch. Yeah, when we trace the capital flows and the regulatory backdrop here, it is such a fascinating contrast.
Right.
Because institutional capital is flowing directly towards staking yields via these new exchange-traded products, which we will absolutely break down.
Oh, yeah, we have to.
Meanwhile, the regulatory hopes that a lot of the industry had, well, they're dimming quickly, specifically as the Senate Clarity Act vote basically stalls out.
Yeah, it's a mess. So before we get into the mechanics of all this, here are the 4 key takeaways you need to understand from this deep dive into our sources from the Nifty Noon newsletter.
You lay them out.
First, Wall Street is officially moving beyond mere price exposure to actual native yield generation. That's huge.
Massive.
Second, the stablecoin war is migrating away from just market capitalization and straight into the courtroom and patent offices.
Which we saw with Circle, right?
Exactly. Third, there's this new loss-to-earn gamification model that is completely reshaping how we think about NFT liquidity. And fourth, decentralized discovery is just rapidly consolidating into unified aggregators.
So much to cover. Let's unpack that split-screen reality, starting with what was happening in the retail trenches early this week.
Fun stuff.
Yeah, the truly degenerate stuff. So major assets like Bitcoin and Ethereum were completely sideways, just chopping around, no real momentum.
Very boring surface-level action.
Right. But beneath that boring surface, there was this intense, hyper-localized activity bubbling up on the Ethereum network. And it was all centered around a protocol called Fake World Assets, or FWA.
The mechanism here is honestly fascinating. So TokenWorks launched FWA as an on-chain NFT Gacha protocol.
And if you aren't familiar with Gacha mechanics, think of it like a decentralized vending machine.
Yeah, basically. Users spend Ethereum for a randomized chance to pull deposited blue-chip NFTs out of a pool, like a CryptoPunk or a Pudgy Penguin.
It's essentially a Dave & Buster's claw machine. But instead of a $2 stuffed animal, you're fishing for a $100,000 CryptoPunk.
Exactly.
And the twist is, the machine actually pays dividends to the people who supplied the toys in the first place, right?
That's the kicker. The depositors get decentralized finance yield and FWA token emissions, which are funded by the people paying to spin the wheel.
Wild.
And the developers executed this brilliant anti-sniper defense, because usually when a token launches, automated bots just buy up the supply in the first few seconds, locking out real users.
Right, the bots just front-run everyone.
So to prevent this, the early FWA supply was completely blocked from open market buying. The only way to earn the token was to genuinely participate. You either had to deposit an NFT or spend Ethereum to spin the wheel.
Okay, I hear you on the mechanics, but let's be real here. Eventually, you run out of degenerates willing to lose money on a digital claw machine, right?
You'd think so.
I have to push back on this. Is this loss-to-earn model actually sustainable, or is it just a temporary flywheel that's wholly dependent on retail trading addiction? Like, how does this not just spiral to zero when the hype dies?
Well, that is the existential question for this entire model. In the short term, it is highly dependent on sustained spin volume to fund those yields for depositors.
So if no one spins, no one gets paid.
Exactly. If the retail volume dries up, the token emissions lose their value, and the depositors will just pull their NFTs out of the machine.
Makes sense.
However, if the protocol can balance their token buybacks, which they plan to fund with protocol fees, it could theoretically become a persistent layer of liquidity for assets that are usually highly illiquid.
I see.
Yeah, it basically turns static JPEG assets into productive yield-bearing instruments, assuming the math holds up over time.
But the math didn't entirely hold up on day one, did it? I saw everyone on social media completely panicking about a V1 exploit.
Yeah, there was some drama.
To me, a stolen CryptoPunk looks like a massive red flag for this whole Gacha model. Why shouldn't I be worried?
Well, mostly because of how the exploit actually functioned and how the team responded to it. An attacker basically managed to front-run the Chainlink randomness callback.
Wait, hold on. For listeners who don't live in the Ethereum trenches, what exactly is a randomness callback, and how do you even front-run a digital spin?
Okay, so think of the mempool, which is essentially just a waiting room for pending transactions. Think of it as a transparent glass box.
Okay, glass box.
Before a transaction is permanently recorded on the blockchain, it sits in that box, visible to absolutely everyone.
Right.
So the attacker requested a spin, and the system generated the random result. The attacker saw the winning outcome sitting in that waiting room. Yeah. Because they could see the future before it was finalized, they manipulated their own transaction fee to skip the line, kind of like tipping a bouncer, and executed their transaction to steal the CryptoPunk.
So they essentially looked into the dealer's hand before placing their final bet.
That is a great way to put it, yeah. But to the team's credit, they swiftly patched the smart contract and refunded the victim completely out of pocket.
That's pretty rare.
It is. That ethical response built a ton of trust. By the end of the day, the protocol still hit 16,000 spins and a $28 million token market cap.
Wow.
So as a localized incident, correctly handled, which is why it didn't kill the momentum.
Got it. Well, if you're listening to this and wondering where the actual serious capital is going while retail plays gotcha, let's look at the other side of that split screen.
The institutional side.
Exactly. While retail was glued to the claw machines, institutional players were quietly sweeping up foundational back-end infrastructure. We saw a massive wave of consolidation this week.
Huge wave.
Bitmart announced they are winding down operations after a strategic evaluation.
Yeah, and while one door closes, others are being heavily fortified. Like Kraken stepped in and acquired Magic Labs, which they are now rebranding as Newton Labs.
And Magic Labs is a big deal, right?
A massive player in the wallet as a service sector. They've powered over 60 million wallets. By acquiring them, Kraken can now offer embedded, non-custodial wallets to practically any application.
So what does that mean for the end user?
It means a developer can build an app where the user doesn't even realize they are using a crypto wallet. The friction is completely removed.
That is exactly what the industry needs.
Yep. And at the same time, we saw Ondo Network launch its execution layer specifically designed for open financial markets and real-world assets.
So we have this quiet infrastructure build-out happening, but then the narrative aggressively shifts to corporate defensive posturing. Let's talk about the intellectual property wars.
Oh, this was a crazy story.
Circle, the issuer of the USDC stablecoin, just acquired nearly 1,000 issued blockchain patents from IBM.
This is a monumental acquisition. I mean, Circle is now the largest blockchain patent holder in the United States.
Are these just, like, junk patents or what?
No, these aren't just generic patents. They cover foundational architecture, secure cloud operations, and supply chain verification.
It's like a medieval kingdom buying up all the iron mines.
Yeah.
They aren't necessarily trying to forge swords to attack anyone right now, but they want to ensure no rival kingdom can build weapons to use against them in the future.
That analogy is spot on. I mean, Circle isn't just a stablecoin issuer anymore. They are building the Circle Payments Network and their institutional Layer 1 blockchain, ARC.
Right.
When you are building the core infrastructure of the internet financial system, your biggest threat isn't always a better product. It's patent trolls and corporate litigation.
Yeah, death by 1,000 lawsuits.
Exactly. This portfolio creates an incredible defensive moat around their entire tech stack.
But there's a glaring contradiction here in our sources. IBM is actually backing Open Standard, which is a recently launched stablecoin consortium. There's a direct rival to USDC. So why would IBM sell their intellectual property to their competitor's biggest threat? Is Circle gearing up to play offense against patent trolls and rivals?
It suggests two strategic realities, really. First, IBM might just be monetizing non-core assets to fund their own initiatives. They probably decided the immediate cash is worth more than holding the patents.
Makes sense from a balance sheet perspective.
Exactly. And second, for Circle, the best defense is a strong offense. Even if they never sue anyone, holding 1,000 core patents forces competitors, including Open Standard, to tread very carefully to avoid infringement.
It changes the entire power dynamic of the stablecoin sector.
100%.
And while Circle was securing the back end, we saw a massive leap in real-world utility on the front end. Emirates Airlines launched Crypto.com, pay for eligible UAE residents.
That was wild to see.
Yeah, you can now literally book a flight using your digital wallet, settled in Emirati dirham. This isn't buying a cup of coffee. This is international travel.
And this integration aligns perfectly with Dubai's D33 economic agenda, which actually has a stated goal of digitizing 90% of all financial transactions by 2026.
Wow, 90%.
Yeah. Emirates is a highly profitable global airline, and this is exactly what the industry has been promising for a decade. Seamless, high-value commerce.
And to make sure those digital ecosystems remain secure as they scale up, Base launched a tool called Verify On-Chain.
Right.
It's designed to protect airdrop rewards from Sybil farmers. For anyone listening who is unfamiliar, Sybil farmer is essentially one guy putting on 10,000 different digital masks to trick a network into thinking they are a massive crowd.
Just to hoard rewards meant for actual real users.
Exactly.
Well, security and verification have to scale alongside utility. If you are going to process airline tickets and institutional payments, you need to know exactly who is interacting with your network.
Which sets the stage perfectly for the biggest institutional move of the week. Institutional capital is demanding way more than just price exposure to digital assets right now. They want native returns. And Morgan Stanley delivered.
They really did.
They launched spot Ethereum and Solana exchange-traded products on NYSE Arca with a rock-bottom fee of 0.14%.
That fee undercuts almost the entire market. But honestly, the fee is just the hook.
Right.
The massive structural shift here is that Morgan Stanley plans to stake the underlying Ethereum and Solana tokens and pass those staking yields directly to the investors.
I want to make sure you fully grasp the magnitude of this if you're listening. This is crossing the Rubicon.
Totally.
It's the difference between a Wall Street firm letting you buy gold bars and keep them in a vault versus letting you buy a piece of the gold mine that actively pays you dividends every single day.
It's a completely different value proposition.
But how do they actually do this technically? Because an ETF wrapper passing on a native blockchain yield sounds incredibly complicated.
Oh, it requires an incredible amount of regulatory and technical gymnastics. Morgan Stanley basically has to work with institutional custodians to take the raw Ethereum and Solana and lock it into the blockchain's consensus mechanism to secure the network.
Right.
Then they collect the protocol rewards, convert or account for those rewards in fiat terms, and finally distribute that value back to the share price of the exchange-traded product.
That is wild. They are taking traditional, cautious capital and plugging it directly into the yield-generating mechanics of smart contract ecosystems.
Yeah. And consider their distribution network. Morgan Stanley has 16,000 financial advisors overseeing $9 trillion in assets.
Unbelievable scale.
Their Bitcoin trust already hit $400 million. Now, those same advisors can call up their clients and offer a digital asset product that actually produces a yield.
Which fundamentally changes how these assets fit into a traditional portfolio construct.
Exactly. The market momentum is undeniable, but we do need a regulatory reality check here.
Yeah, let's look at Washington.
While Wall Street is adopting the technology and building these complex products, Washington is just stalling out. The Senate Clarity Act is facing incredibly long odds for a floor vote.
What is actually holding it up? Because we hear about these bills constantly, but they just seem to vanish into a black hole.
It comes down to procedural math and the calendar, honestly. The Senate leaves for their scheduled recess on August 7th.
Okay.
That leaves almost no floor time. Furthermore, bringing a bill to a vote requires invoking cloture, which is the procedural hurdle in the Senate to end debate and force an actual vote.
And how many votes does that take?
Invoking cloture requires 60 votes. So the current scheduling and procedural realities make finding those 60 votes and getting floor time highly unlikely before they break.
We aren't taking a stance on the politics of the bill itself, but strictly from a market perspective, that stagnation is just a wet blanket.
Absolutely.
The industry wants clear rules of the road, and it looks like they will just have to wait longer to get them.
It forces companies to operate in a gray area, relying on patent defenses like what Circle is doing rather than clear legislation.
Let's move to the end of the week. We had this collision of massive on-chain volume happening right alongside some truly punishing macroeconomic realities for centralized players.
A very chaotic Friday.
Let's start on-chain. Uniswap launches aggregator tab in beta on the Robinhood Chain.
This is a big deal for UX. Until now, discovering new tokens meant jumping across highly fragmented niche launchpads like Banker, Pawns, and Long.
The user experience was terrible.
Just awful. Uniswap unified all of those fragmented sources into a single clean feed directly inside their web app. And the volume they're aggregating is staggering.
What are the numbers looking like?
Well, Robinhood Chain saw 340,000 new tokens and $3.6 billion in volume in July alone.
Wow.
When this aggregator was announced, the UNI token surged 12%.
Okay, I have a philosophical pushback on this.
Let's hear it.
By centralizing the discovery of all these tokens into one clean Uniswap feed, aren't we just rebuilding the centralized systems crypto was meant to replace? Like, is this just the necessary cost of a good user experience?
It is the classic tension between decentralization and usability. If discovery is too fragmented, retail investors get frustrated and simply leave.
That's true.
Uniswap isn't taking custody of the assets, so the actual execution of the trades remains decentralized. But they are absolutely centralizing the attention layer. And in modern markets, whoever controls the attention controls the liquidity routing.
That added attention wasn't enough to save the centralized players this week, though. Coinbase stock plunged over 7% after they missed their earnings expectations.
Yeah, that was a tough print for them.
But the really wild story, the one that completely blew my mind, happened with Citadel and Leopold.
Oh man, this is a masterclass in ruthless market structure. So Leopold operates a situational awareness portfolio.
Which sounds like corporate speak. What does that actually mean in plain English?
Right. A situational awareness portfolio is a fund built entirely around trading on geopolitical or macroeconomic events as they happen. They try to predict the news.
Okay, got it.
And Leopold was heavily leveraged. Earlier in the week, Citadel made a very public prediction of a surprise Federal Reserve rate hike.
Which historically tanks the market because higher rates mean less cheap capital flowing into risk assets.
Correct. The mere prediction of a rate hike from a player as massive and influential as Citadel caused the market to sell off in anticipation.
Because everyone follows what Citadel does.
Exactly. Because of that sudden sell-off, Leopold's portfolio value dropped sharply. They were hit with a margin call from their lenders that they couldn't meet.
Oh, no.
Because they couldn't post more collateral, they were liquidated, their assets were forcibly sold off. Then, after all that, the Federal Reserve actually left rates unchanged.
That is just, that is incredibly ruthless. It's financial PDP. So who was there to acquire Leopold's entire liquidated portfolio at a steep discount? Of course. They essentially spooked the market with a prediction, triggered the liquidation of a highly leveraged competitor, and bought up their assets for pennies on the dollar.
It highlights how sensitive these markets are to narrative and prediction, and how larger players can weaponize market psychology against over-leveraged competitors.
Speaking of predictions, wrapping up the week, there's one quick metric from the nifty noon sources that I found absolutely fascinating.
The Robinhood stat.
Yes. Robinhood is now earning more revenue from prediction markets than from traditional stocks or crypto trading.
That statistic perfectly encapsulates where retail attention is shifting right now. It's moving away from long-term asset holding and toward immediate event-driven speculation. Users want to bet on outcomes, not just hold assets.
So let's synthesize this. When you look at the entire stack of sources from the week, what actually mattered?
I'd say three things fundamentally altered the foundation of the market this week. First, Morgan Stanley passing native staking yields to traditional investors. It validates the economic model of Layer 1 networks to the traditional finance world, and it fundamentally changes ETF mechanics.
And the second?
Circle's massive intellectual property acquisition from IBM. It completely rewrites the defensive posturing and power dynamics in the ongoing stablecoin wars.
And third?
Uniswap successfully acting as the ultimate liquidity funnel for early-stage assets. That is a critical structural shift in how tokens are discovered, proving that aggregation really does win the attention game.
And what was mostly noise? because a lot of people were panicking on social media about various things this week.
The fake world assets V1 exploit was mostly noise. Yes, it generated scary headlines about a stolen CryptoPunk and mempool manipulation.
Right.
But the team patched the contract immediately and refunded the victim out of pocket. It had no lasting negative impact on the protocol's momentum, nor did it slow down the broader gamified liquidity trend we are seeing. It was a localized, technical incident that was correctly handled.
Looking ahead to next week, what should we be keeping our eyes on?
Keep an eye on Washington. Watch whether the Clarity Act can miraculously overcome the procedural math and secure 60 votes before that August 7th Senate recess, though again, the odds are incredibly slim.
Unlikely, yeah.
On the tech side, watch how quickly Uniswap expands its new aggregator beyond the Robinhood Chain to other networks. If they capture that attention globally, they own the top of the funnel.
And for traditional markets.
Watch to see if Coinbase can recover its momentum following that earnings miss, or if traditional finance players continue to eat into their market share.
I love it. Before we go, I want to leave you with one final thought to mull over. We talked about that staggering Robinhood stat earlier.
Right, the prediction markets.
If prediction markets are generating more revenue for Robinhood than actual stocks and crypto, are we moving toward a future where every global event, every election, every Fed meeting, every pop culture moment is instantly financialized, making traditional stock markets just a slow-moving sideshow?
It's a wild thing to consider.
It really is something to think about as you watch the chart this weekend. Thank you so much for joining us for this deep dive. If you want to stay ahead of the curve, make sure you follow Nifty Noon on X and subscribe to our newsletter on Substack. We are your trusted source of signal in a very noisy market. We will see you next time.